There's so many people out there that want to invest in real estate. They want to start going and, they don't know where to go and get the capital for it because everybody has unique situations. Some people are self-employed, other people are W-2. Some people may not have an employment. They might just have assets and then they need a no doc type of loan. So I'm curious to hear your take on these different financing options for investment properties, Paul.
Sure, absolutely. Great question today. As you know, a lot of people out there, investors, always looking for different opportunities, ways to get these properties. And, to be honest, the more traditional clients, the W-2 clients or the clients that have maybe businesses that show a lot of profit, they always go conventional financing, which again, nothing against conventional. It's a great option for the right clientele. And with conventional financing on a single family home, typically you can put down as little as 15%. 15% down, 6 months reserves, common. But most of the time, let's be honest here, if you're an investor, you're not buying a single family home. You're probably buying a multifamily more often than not, a 2 to 4 unit or even a 5 unit plus. So with that being said, conventional is still an option, of course, but it does require 25% down on the 2 to 4 units, as well as 6 months reserves. And another thing that I wanted to mention, which makes conventional somewhat of a difficult sell, is with the pricing, it's a little bit higher the rate, yes, but also the closing costs can be extremely high on a conventional investment property to the point where it almost steers certain investors away. So that's why I do mention this as an option. I would say 8 times out of 10 investors don't want to go conventional because of that. So what I want to talk about more or less is portfolio programs that Northpointe Bank offers for investors.
A portfolio are products and only which your bank offers, correct?
Correct. A portfolio loan essentially is an in-house loan where the guidelines, while there are certain guidelines we adhere to, we also have the ability to make a judgment call. We look at compensating factors. We'll look at the whole picture. So with a portfolio loan, it's almost like our in-house lender or our in-house program with our underwriters making a decision based on, does it make sense? Can they see this, working? So one of the most common portfolio, or as you call it, an in-house loan that we offer. And it's called a DSCR loan. I know we talked about these in the past. These are loans, almost a no doc essentially, where we'll look at a situation where, okay, let's say a 3-unit property in, East Providence, Rhode Island. Let's say fair market rent, just throwing numbers out here. Let's say it's $1,800 per unit. 3-unit property, $1,800 per unit, that brings in $5,400 a month. Essentially, if your new mortgage payment, principal, interest, taxes, and insurance is at or less than $5,400 a month, you're approved. I mean, it does require 20% down, which is better than the 25% down that conventional requires. And in addition, it's a 30-year fixed rate. Essentially, you put down 20%, you have a 640 credit score higher, and as long as the rent covers the mortgage, you're approved. It's a pretty good loan for a lot of those investors out there who don't want to deal with a lot of the paperwork and just want to get in the house very quickly. Something else I want to touch on just a little bit here is we talk about portfolio. The DSCR by far is the most popular we talked about. But we also have other, they call non-QM. It's basically programs, again, that they create internally for certain clients. So it's this one here, we call it prime non-agency. In a nutshell, what it does is it allows people that, again, maybe on their tax returns don't show a ton of money, or maybe they do show a lot of money, but they don't want to pay the higher closing costs. So this is a program we have where the rate may be a little bit higher. So I'll be honest, the average investment property here, it's kind of weird saying this. The average investment property with conventional financing, you're paying between 2 and 3 points in closing costs. So what is that? What do points mean? Let's just say hypothetically, you're buying a $500,000 property. And let's say closing costs in general are about, say, $10,000 for a $500,000 home. But if you have to pay 2 points, 2 points would be another 2%. So that's another $10,000, or 3 points could be 3. So that's about $15,000. So essentially, instead of closing cost being $10,000 like normal, you're looking at $20,000 to $25,000 in closing costs on a conventional loan. So you can see why a lot of investors would want to stay away potentially. With our in-house, the rate, we have a special program, Prime Non-Agency, where we don't charge those points. You can actually get a rate at what they call par. Par means you're not paying any additional fees beyond the traditional closing cost. So imagine buying a $500,000 home, a 3-unit property, putting down, say, $10,000 in closing costs, 20% down, but now you're not paying those points and you're not paying the 25%, only 20. So it's a way to you to minimize your out-of-pocket cost to buy a property. And rates are maybe a 0.5% higher. So many people say, I'd rather do that and save $15,000, $20,000 versus, getting a little better rate and paying the out-of-pocket.